Estimating the costs and benefits of debt.
Trade-off theory suggests that there is an optimal level of debt that balances the costs and benefits of debt. Various models suggest that the optimal capital structure consists of about 65% debt, whereas observed debt levels have been, on average, about 30%. Only recently, however, has the research begun to adequately quantify the costs and benefits of debt. The value of the tax shield. Graham examined the value of the tax shield and found that the aggregate tax benefits of the shield were significant. At their highest, tax benefits of debt for a sample of 6,087 firms totaled $114 billion in 1990.20. He also created a model to measure the value of the interest tax shield at the firm level and found that the tax benefits of debt amounted to 9.7% of firm value. However, despite the significant benefits of debt financing, even large, well-established firms tended to have conservative debt policies. More than 44% of the firms examined underutilized debt despite the fact that even after taking into account the costs of bankruptcy, firms could still benefit from the debt tax shield if they were to double their debt. Boyne, Core, and Gay claimed that Graham's study overestimated the tax benefits of debt, and that estimates of future tax-related cash flows were flawed since other tax benefits such as tax loss carry-forwards and carrybacks had been ignored. 21 Using an improved method to estimate marginal tax rates, they showed that although firms were not as under-leveraged as previously thought, between 18.5% and 29.2% of them were under-leveraged, and that an increase in leverage could have added 1.3% of value to the firm. 22. The costs of debt. Studies of the cost of debt have historically focused on small samples of bankrupt firms. These studies estimated bankruptcy costs to be between 3.1% and 20% of firm value. Building on Graham's work, Van Binsbergen, Graham, and Yang developed a model to analyze the costs and benefits of debt. 23 They used a model to develop an optimal capital structure, and compared the costs and benefits of this optimal, equilibrium, capital structure to observed capital structures. Their findings suggested that default costs amounted to 6% of book value for investment-grade firms and 17% for low-grade firms. The average benefit of debt at the equilibrium level was 10.4% compared to an observed benefit of 9.0%. The cost of debt at the equilibrium level was 6.9% compared to an observed level of 7.9%. The equilibrium net benefit of debt was 3.5% compared to an observed benefit of 1.1%, which suggests that firms are under-leveraged. Costs of suboptimal capital structure. Van Binsbergen, Graham, and Yang quantified the costs of operating with suboptimal capital structures. 24 Their results showed that the cost of having too much debt was disproportionately higher than the cost of having too little debt. If the average firms with equilibrium capital structures were to double their leverage, they would lose about 6.7% of firm value. Whereas if the same firms were to eliminate their debt they would lose 4.5% of their value.